This is part one of a series of two pre-lecture videos on money for the course Global Business Economics. I'm David Frankel, a professor at Melbourne Business School. Let's get started. We begin with the fundamental question. Why do we use money? Why not barter? For instance, you bought a new fridge and would like to get rid of your old one. You also want a used oven as your old one is broken. Why can't you simply find someone who has an extra oven but no fridge? The answer is that it's very hard to find such people. Lots of people have ovens to sell. For instance, they might have just bought a new one. And lots of people need fridges. But very few people both have ovens and need fridges. And if you do happen to find someone like that, your fridge and her oven may not be of comparable value. So there's a risk that one of you may reject the swap. This is called the problem of double coincidence of wants. It's solved by money. You sell your fridge to someone who needs it. They pay you money. You use the money to buy an oven from another person. If the fridge and oven differ in value, it's no problem. When you buy the oven, you can add to or subtract from the money you got for your fridge. What can a society use as money? Well, modern societies generally use coins and bills. But in practice, anything that is lightweight, compact, durable, and of uniform quality can serve as money. In prisons, for instance, cigarettes are often used. But an item is useful as money only if it is universally accepted. This is a kind of self-fulfilling prophecy. For instance, a store proprietor will accept money as payment because she expects to be able to buy stuff with the money later. But if you tried to pay her with cigarettes, she would be unlikely to accept. Why? Because she does not expect to be able to buy stuff with the cigarettes later. That is, unless she's going to prison. But then you should probably not be doing business with her anyway. So far, we have been thinking of money as cash, that is, paper bills and coins. But stores will accept other forms of payment, checks and debit cards, for instance. Economists define money as the funds that are available for immediate payment by the public, by which we mean households as well as firms other than banks. Money takes two forms. The first is currency, coins and bills held by the public. The second is the public's deposits in checking and savings accounts. What about lines of credit, such as a borrowing limit on a credit card? Your credit limit itself is not regarded as money. However, the payments you make do become money when they are deposited in the recipient's account. For instance, if you pay a merchant $100 with a credit card, your card issuer transfers $100 to the merchant's account. When it reaches his account, it becomes money. So when you use a credit card to pay for something, you are actually expanding the money supply. And when you pay your credit card bill, you are shrinking the money supply. Why? You are taking $100 out of your account, where it is regarded as money, and returning it to the bank that issued the card, where it is not regarded as money. We now turn to our central question. What determines the quantity of money in the economy? That is, the size of the money supply. The prior credit card example shows that money is created when the public borrows from banks. But banks are limited in their ability to lend. For every dollar a bank lends out, it must keep some funds as reserves. This is called the system of fractional reserve banking, and it helps determine the money supply in the economy. To see how this works, let's consider a simple example. A woman named Jo opens an account at NAB where she deposits some money. The bank has another client, Flo, who wants to borrow money to fund her business. This loan is profitable for the bank. It can charge Flo an interest rate that exceeds the rate that it pays to Jo. But even so, NAB doesn't lend all of Jo's money to Flo. Rather, it sets some of Jo's money aside as reserves. Why? What is the bank worried about? First, the bank is worried that Jo might withdraw cash from her account. Typically, this will happen at an ATM. The bank doesn't want its ATMs to run out of cash, so it puts a bit more money in its ATMs to handle the extra demand from Jo. Second, Joe might write a check to someone who deposits it in another bank, say ANZ. At the end of the business day, in a process called check clearance, ANZ demands that NAB pay it the amount of Joe's check. If NAB doesn't have enough, the RBA will impose a fine or other penalty. So, NAB sets a bit of Joe's deposit aside for check clearance in a special account at the RBA that is called an exchange settlement account. The reserve ratio, denoted R, is defined as the ratio of a bank's reserves to its deposits. Let's now work through a simple example. We will assume that the reserve ratio R is 10%. That is, a bank keeps 10 cents of each dollar in deposits and lends out the rest. Now suppose that the RBA buys a bond for $1 from Mo, who deposits the dollar in his bank account. Since bank deposits are counted as money, this action raises the money supply by $1. Worrying that Mo might write a check or withdraw funds from an ATM, Mo's bank sets aside R dollars in reserves. It lends the remaining 1 minus R dollars to Flo, who deposits the funds in her account. Since Flo's deposit is also counted as money, this action raises the money supply by 1 minus R dollars, or 90 cents. Flo's bank then lends a proportion 1 minus R of Flo's deposit of 1 minus R to Joe, who deposits the funds in her account. This action raises the money supply by 1 minus R times 1 minus R dollars. This is just 0.9 squared, which equals 0.81. That is, the money supply rises by another 81 cents. The process continues in this way ad infinitum. The total increase in the money supply is thus $1 plus 1 minus R dollars plus 1 minus R squared dollars, and so on. By the familiar formula for a geometric series, this equals 1 divided by 1 minus the quantity 1 minus R, or more simply, 1 divided by R. In our example, R is 0.1, so the RBA's purchase of a bond for $1 has a cumulative effect of raising the money supply by $10. In our prior example, every person deposits all of the money she receives in her bank account. But in practice, she might like to keep a portion of her money in the form of cash, that is, notes and bills. For instance, she may need to pay cash for some upcoming purchase. Or she may worry that the banks are not entirely safe, and thus prefer to leave some cash under her mattress. To capture this, we define a new concept. The currency drain ratio, denoted by C, equals the cash held by the public expressed as a percentage of the public's bank deposits. To illustrate, let us suppose once again that the RBA buys a bond for $1 from Mo. But instead of depositing the entire dollar, Mo stashes 20 cents in cash under his mattress and deposits the remaining 80 cents. Mo's currency drain ratio C is thus 0.25, the ratio of his cash of 20 cents to his deposits of 80 cents. Now suppose Mo's bank sets aside 8 cents of his deposit as reserves and lends out the rest. The bank's reserve ratio is then 0.1 as before, its reserves of 8 cents divided by Mo's deposit of 80 cents. Importantly, both the currency drain ratio C and the reserve ratio R are expressed as percentages of the same 80 cents in deposits. Given that a loan recipient will set aside part of her loan as cash, by how much does the purchase of a bond by the RBA now raise the money supply? We answer this question in the next video in this series, which is titled Money 2 Advanced Concepts. This concludes the GBE pre-lecture video, Money 1 Basic Concepts. Thank you for watching.